While everyone is scrolling past feel-good skyline shots of San Francisco and for sale posts from Silicon Valley influencers, something unexpected just happened. The person who built his political brand on California's comeback now looks like he's on the ropes. The governor is scrambling. Press conferences are thin on answers. Local leaders are publicly worried. The Bay Area housing market, the thing that powered wealth, startups, and headlines for decades, is shifting in ways that aren't being explained by clickbait. This isn't a tidy prices up, prices down story. It's a tangle of job cuts, empty offices, changing migration flows, policy fights, and a cost of living squeeze that has middle-class families making impossible choices. If you own property in the Bay Area, rent here, or are thinking of moving back, this video breaks down what's really happening, why the governor is being forced to react, and exactly what to watch next. Start with the numbers that make pundits uncomfortable. Over the last several years, California experienced dramatic population churn. Millions left in the pandemic-era wave of domestic migration. Some of that outflow has slowed or reversed thanks to international arrivals, but the net effect has been a structural shift in who lives here and how many people can afford to. From 2020 through 2024, California recorded enormous domestic outflows and only partially offset them with international migrants. The long-run math that once supported Bay Area housing demand changed. San Francisco itself became the poster child for that shift. The city saw a steep population drop after the pandemic, taking a hit larger than most American metros. Although there's been a modest rebound in some groups, the overall workforce composition and the count of households that once fueled daily demand for housing, restaurants, and transit remain unsettled. That matters because when buyers or renters disappear, every other lever, prices, rents, lender appetite, starts to move in ways few expect. At the heart of the Bay Area market's wobble is the tech cycle. For years, the region's housing market marched to the tune of venture capital, stock option windfalls, and aggressive hiring. But 2024 and 2025 brought waves of tech layoffs, restructured hiring, and the rise of AI-driven efficiencies that meaningfully reduced payroll growth in the places that once imported workers every week. Fewer high-paid hires means fewer high-priced rentals leased and fewer all-cash offers. The result is brutally simple. Demand cools, and a market built around scarcity and outsized incomes recalibrates. Now let me explain the mechanics of what that looks like on the street. Imagine a new downtown condo building that in 2021 expected a steady stream of tech renters paying top-dollar monthly rents. Fast forward to today. Hiring freezes mean fewer incoming employees. Some existing residents have moved out. Companies are occupying less office space. The expected rental rotation never arrives. Units that would have turned over every 6 to 9 months now stay empty for longer. Listings swell. Landlords lower asking rents or offer concessions. Meanwhile, lenders become picky, and appraisers temper comps because the comparable sales in the last boom reflected a very different demand environment. Multiply this pattern across tens of thousands of units, and you have the supply-demand inversion we're seeing in pockets across the Bay Area. But this is not just a job story. Office vacancy rates are critical to understanding why housing is slumping in certain neighborhoods. Large chunks of downtown office stock remain unused, and that has ripple effects beyond just the landlords. The absence of office workers reduces foot traffic, impacts local small businesses, and makes certain transit-connected neighborhoods less desirable for the people who once paid premiums to live nearby. Analysts calculate that converting vacant offices into housing is technically possible at scale in San Francisco. Tens of thousands of units could be repurposed if the political will, financing, and zoning changes come together. But conversions take time, money, and political capital. In the meantime, those empty towers cast a long shadow over neighborhood economics. Political pressure piled on top of these economic shifts. The governor has been pushing big housing reforms, moves to speed approvals, cut litigation that stalls projects, and incentivize dense building near transit. But these actions have also become lightning rods for critics who say the changes are being rushed or ignore local concerns. Sweeping changes to environmental review rules and streamlining authority are billed as necessary to get supply moving. Opponents argue they undercut community input and environmental protections. The result: the governor is squeezed between mayors and neighborhood groups demanding caution and housing advocates demanding speed. That tug of war has left the governor publicly defending policy while privately watching downtown vacancy charts and migration numbers. Recent legislation shows that the state is moving aggressively, but implementation takes months or years, and housing markets rarely stabilize overnight in response to new laws. Let's lay out the immediate pain points for Bay Area homeowners and renters. First, affordability. Even after some price easing in selected neighborhoods, median prices remain near historically high levels relative to local incomes. Mortgage rates, while lower than a year ago in some cycles, remain materially higher than pandemic lows. Monthly payments that once seemed manageable are suddenly a stretch for households that aren't on the top end of tech compensation. Second, inventory dynamics. Certain neighborhoods are seeing inventory creep up, more listings, more price cuts, and longer days on market. Third, the unevenness problem. Luxury and trophy properties with global buyers still show strength in some corridors, while mid-market condos and single-family homes where ordinary families live are languishing. This segmentation makes the market feel simultaneously fragile and superficially strong, depending on what zip code your audience checks. People always ask, is this 2008 all over again? The short answer is no, but there's reason to worry. 2008 was a credit-fueled national crisis with subprime lending baked into the system. Today's Bay Area issues stem from a demand-side shock: fewer high-paid tech jobs, shifts in where people want to live, policy-driven supply responses. That said, pockets of vulnerability exist. Homeowners who bought at peak valuations with minimal down payment, investors who relied on short-term rental income that has since softened, and condo associations burdened by rising maintenance and conversion costs. Those groups can find themselves squeezed into negative equity or forced sales if broader market sentiment sours. Now, a closer look at San Francisco. The city lost a large share of its residents during the early pandemic years. While some cohorts are returning, the composition has shifted. Remote work remains a persistent factor for some employers. International immigration patterns have helped offset losses only partially. On the ground, it looks like fewer long-term renters, more for-sale properties slipping into make-me-move pricing, and neighborhoods that once hosted thriving lunchtime economies now trying to find their new identity. Local government and business groups are urgently debating how to lure people back. Tax incentives, subsidies for office-to-residence conversions, cultural investments. But every potential solution takes time to influence housing metrics. Let's get human for a moment, because data isn't just digits. It's dinner table decisions. Picture a family who bought a 3-bedroom in an East Bay suburb in 2021, banking on steady appreciation and a stable tech paycheck. By 2024, the spouse's company reduces headcount. The rental income they expected from a spare room evaporates. Refinancing options are limited. Or imagine a landlord who bought 3 units as an investment bet, only to find that short-term rental demand softened and annual carrying costs rose with municipal fees and insurance. These are not hypothetical scenarios. The stress shows up as delayed renovations, postponed college savings, and in some cases, forbearance discussions. These human stories feed into the market because sellers act out of necessity. Buyers suddenly have leverage. It's the social side of housing downturns that creates political headaches for any governor. Now, where the governor's panic narrative takes shape. Publicly, the administration has argued it has a multi-part plan: ease permitting, incentivize conversions, target infrastructure dollars to unlock housing near transit. But privately, officials confess that the timeframe to actually produce meaningful units is measured in years, not months. Fiscal constraints, legal pushback, and political resistance limit the speed of change. When the legislature and local governments clash, implementation slows. That mismatch between a fast-moving market and slow-moving government response creates the optics of panic. If homeowners and markets expect immediate action, delayed policy looks like paralysis. The governor's speeches and legislative maneuvers indicate urgency, but urgency without immediate supply relief can feel like reactive damage control. Let's walk through the specific signals to watch over the next 6 to 18 months. If you own property or plan to buy, timing matters more than ever. First, watch population and migration updates. Domestic outflows versus international inflows will determine long-run demand. Second, monitor office vacancy and conversion announcements. When developers and banks commit capital to convert offices into housing, that's a long-term supply event that will ultimately ease price pressure. Third, track local sales velocity. Rising days on market and increasing percent of sales below list price indicate buyers have leverage. Fourth, follow policy implementation. Zoning changes, financing mechanisms, and whether reforms stick after legal challenges. Fifth, keep an eye on credit conditions and lending standards. If lenders tighten, even buyers with income struggle to close deals, which deepens freezes in the market. But let's talk strategy. For homeowners, don't panic sell. Markets rarely move in straight lines. Selling at the first sign of stress can lock in losses you'll regret later. Instead, get granular. Understand your local micro-market. Assess your mortgage terms. Consult a trusted agent who knows nearby comps beyond headline statistics. For buyers, the window of opportunity exists but is complicated. The best buyers in a cooling market have patient capital, a long-term horizon, and a plan for occupancy or renovation. Leveraged short-term flips are riskier now. For renters and would-be residents, use this period to negotiate. Concessions, shorter-term lease incentives, and flexible terms are more likely in areas with rising vacancy. For investors, be surgical. Look for neighborhoods with strong fundamentals, good schools, transit, stable employment pipelines, rather than chasing trophy downtown assets that depend on a tech office rebound. Now to the political theater. Expect more headlines. When market pain hits constituents, governors are forced to act, issuing emergency programs, proposing subsidies, touting tax changes. But emergency programs without structural fixes are temporary relief, not long-run cures. You might see short-term measures, homeowner assistance for those at risk, incentives to preserve affordable rentals, pilot programs for office conversions, but the meat of a market fix is still long-term. Building millions of durable units near jobs and transit, adjusting zoning, making construction economics pencil for developers without compromising community input. Let's predict, not because predictions are guaranteed, but to help you think in scenarios. Scenario A, policy succeeds, conversions accelerate, tech hiring stabilizes, and migration flows level off. Scenario B, policy stalls, layoffs continue, and office vacancy remains high. Scenario C, a black swan, an abrupt macro interest rate shock, or a major corporate exodus could deepen the slump and widen the damage zone. The governor's options change dramatically in each scenario. There are silver linings, and they're important. The Bay Area still has deep economic moats, top-tier research universities, global company headquarters, venture capital density, cultural amenities. That means the region has the capacity to reinvent how it uses space. Communities that adapt smartly can come out stronger and more resilient. Now, a tactical checklist for anyone watching this. If you own, run the numbers. What's your break-even sale price after commissions and taxes? How long can you comfortably hold? If you're buying, get pre-approved and negotiate contingencies. If you're renting, ask for concessions. If you're an investor, diversify geographically and across asset classes. Follow the 5 signals mentioned earlier. Those are the actionable data points that matter more than clicky headlines. A final political note. This crisis is shaping narratives that will matter in next election cycles. The governor is balancing legacy politics, proving he can deliver on housing, with near-term pain that voters feel in their wallets. If the policy changes succeed, he secures a major achievement. If they stall, the political fallout could be intense. That's why the public optics look like panic. Leaders are trying to communicate control even as the underlying market dynamics are messy and slow to fix. So where does that leave you? Don't be ruled by fear or FOMO. Study the microeconomics of your neighborhood. Follow migration and office vacancy numbers. Pay attention to policy milestones. Make decisions that match your time horizon. If you're a long-term resident who can weather a short-term adjustment, this period could be an opportunity. If you're short-term oriented or highly leveraged, caution is warranted. Here's the bottom line. The Bay Area housing market is not collapsing in a single cinematic crash. Instead, it's undergoing a complicated recalibration. The governor's visible agitation is the political reaction to that economic reality. Watch the data. Understand your local micro-market. Make choices with a clear time horizon. Drop your thoughts below. Are you seeing more empty storefronts where you live, or are your neighborhood prices still holding strong? Subscribe so you don't miss the next breakdown. This story is still unfolding. The decisions you make now will matter for years.